right side of it. Welcome back. It's good to have you. You know, what's interesting to me is you say that the risk reward in the market is still positive. I'm wondering, though, whether that spread is starting to narrow.
Hi, good afternoon, Scott. To us, stocks are rising for the right reasons. I know I've said that before because we've had good earnings, but also just evidence of really the scarcity of compute and the supply chain, whether it's semis and energy, and AMD's the latest example. But the market hasn't made these stocks expensive yet. The forward PE of the semi index is still only 22 times, and while that might sound high because they were expensive, more expensive than a month ago, they had gotten as high as 35 times over the last 20 years. So to me, there's still pretty good risk reward, even in the stocks that are leading this rally.
So the risk reward is still fairly balanced, I hear you suggesting. Is that right?
Yes, and I think that there's still, there was so much skepticism as the war started and reached its crescendo that we do believe there's still a lot of money on the sidelines. And, in this case, I think it's actually more retail investors that are chasing this move, and that may explain why we're seeing such big moves in things like memory and semis.
You don't think that, sentiment or what's being reflected in the market by virtue of some of these moves has gotten a little bit too much? I bring up this note today from Ed Yardeni, obviously friend of the show. He's on frequently, is talking about to infinity and beyond, what he's calling now the Buzz Lightyear theory, BLT of AI. The data revolution is going to infinity and beyond. He says he's even more bullish than his original Roaring 2020s scenario. Is that well-founded? Is it a point of concern? If you start getting some of the folks who are generally speaking pretty bullish to sound almost euphoric, is that something to worry about?
I think it's something we have to calibrate because I'm actually here at the Milken conference, and I think one of the recurring themes is that AI for the U.S. is probably adding 2 percentage points to GDP each year for the next 5 years. That's like 6% S&P earnings growth coming from AI productivity. And balancing that is, I know a lot of rational investors that continue to point to this coming shortage of petroleum products. So I think there's enough logical reasons for people to stay cautious, but I think there's now a fundamental argument for why AI is causing earnings growth without inflation. And so that is a good combination for stocks.
But see, I look at what you still suggest is a three-phase market. That's how you characterize it. A rise of the S&P to 7,300, check, right? We're there, beyond it. But then you talk about headwinds emerging. See, as we started this year, to refresh everybody's memory, you thought we were going to have a really good start to the year. We would drift into a bear market before another upswing would take us even higher into the end of the year. Now, when the war broke out and we had about 10% or so pullback in the S&P, I thought, well, maybe that's Tom's moment. He couldn't get the timing right, because who can? But that was the pullback, and now we're so bulled up on AI that maybe we're going to do just fine for the rest of the year. But you're still looking for a drawdown of 15 to 20%. Is that right?
I am, Scott. I think that 7,300 originally was like an aspirational level, and now that we're here, I think that there still is fuel for a move higher from here. But we do have to confront later this year two things, and maybe it won't affect the markets, but I think it's the trigger for a drawdown. One is, of course, the market will test a new Fed, and this incoming Fed chair has some different theories on the sources of inflation and how to read inflation, and so the market, I believe, will put those views to the test. And of course, the second is that every day that the Strait is closed, we know that there's an acute shortage developing of petroleum products. So if price reacts later this year, that's going to test the market. So I do think there's the ingredients for turbulence later, but AI and the scarcity, and the U.S. is the provider of that scarcity, is why I think we can exit 77 or higher, and maybe 2027 is one of the biggest rallies we see in our lifetime. So I think it's still a bullish outlook, but turbulence in the middle.
Hey guys, welcome back to my channel. I hope you all are doing well today. So without wasting time, let's start our video. Nvidia latest global expansion, so the AI race is accelerating. Just when an investor thought the AI might need a breather, Nvidia delivered another reminder that the global AI build-out is still moving full speed ahead. Over the past few days, Jensen Huang has been making headlines across the South Korea, announcing a series of major partnerships that could further strengthen the Nvidia position at the center of AI revolution. The announcements were just a symbolic. They highlighted something much bigger. Countries, cloud providers, telecom operators, and technology companies are now racing to build national AI infrastructure, and Nvidia want to be the foundational powering all of it. One of the most important development involves Nvidia expanding partnership with South Korea technology leaders. The company is working alongside memory giants like SK Hynix, telecom operators, and major AI platforms providers to accelerate the construction of next generation AI infrastructure. Among the biggest announcement was plan to build gigawatt scale AI cloud infrastructure in Korea using the Nvidia AI factory architecture. The first phase is expected to come online later this decade. While the headlines focused on deals themselves, investors may be missing the bigger story. Nvidia is no longer simply selling the GPUs. The company is selling an entire AI factories. That's a completely different business opportunity. Instead of providing individual component, Nvidia is helping government and enterprises design full AI ecosystem that include computing, networking, software, memory, and the cloud infrastructure. And that opportunity could be significantly larger than many investors currently appreciate. Another critical takeaway from Korea announcement involves memory. AI demand continue growing faster than the supply. Advanced memory remain one of the most important bottlenecks in the industry. That's why Nvidia deepening relationship with memory suppliers is so important. Without enough high performance memories, AI systems cannot operate at a maximum efficiency. As AI models become larger and more sophisticated, memory requirements continue increasing. Every new AI factory, every new cloud development, and every new generation of infrastructure require more advanced memory solution. That's create a powerful tailwind throughout the supply chain. Meanwhile, the concern about slowing AI spending continue to clash with reality. The evidence coming from customers suggests the opposite. No major company want to risk falling behind. Cloud providers are spending aggressively, and technology companies and government and the every participant understand the same thing, that missing the AI wave could be far more expensive than investing in it. That mindset is driving one of the largest infrastructure build out the technology industry is ever seen. What particularly interesting is that demand continue overwhelming the supply. Industry executives repeatedly point to constant involving compute memories, networking power, and the data